Have you ever stopped to question why the ultra-wealthy appear to inhabit an entirely separate financial universe from the average person? I'm talking about that elusive turning point where money stops being a target you keep chasing and transforms into a workforce that operates on your behalf, according to my research. There is a specific numerical threshold where this remarkable shift takes place, and the truth is, it looks nothing like what the majority of people assume. My name is Gen Z Invest, and for years, I've dedicated myself to examining the patterns of wealth accumulation, tracking individuals as they crossed various financial finish lines, and breaking down what genuinely changes when your investment portfolio reaches specific figures. What I have uncovered might totally flip your current perspective on wealth creation, because something fundamentally distinct occurs when you accumulate $1 million in invested assets, not earned income. Not total net worth, but specifically capital that is deployed and generating returns for you. The general public tends to believe that building wealth follows a straight line. They picture $200,000 as simply twice as good as $100,000, and $1 million as merely 10 times better than $100,000. However, that is not how money behaves when it reaches substantial scale. Specific milestones completely alter the underlying rules of the game. And the $1 million mark represents the single most critical threshold that most individuals will ever encounter. Let me explain the hidden dynamic that nobody seems to discuss. Once you hit $1 million in invested capital, you don't simply possess a larger bank balance. You are literally reclassified as a different category of participant within the economic system. You make the leap from a person who exchanges their hours for currency into a person who owns income-generating capital. This isn't just a theoretical distinction, it is a mathematical reality that reshapes everything about your lifestyle, your career, and your appetite for risk. Allow me to demonstrate with some calculations that will likely catch you off guard. With $10,000 invested at a 7% annual return, your passive income lands at roughly $700 per year. A nice bonus, but hardly a life-altering sum. With $50,000 invested, you are looking at about $3,500 annually. Again, it helps, but you remain entirely dependent on your paycheck for survival. Now watch how the math turns outrageously in your favor. $1 million at that same 7% return delivers $70,000 per year without you moving a single muscle. $70,000. That figure exceeds the full-time salaries of a significant portion of the workforce. It demands 0 hours of your schedule, 0 commute, and 0 tolerance for difficult bosses or office politics. Consider what this means in tangible terms. Recent data indicates that the average American household spends around $67,000 per year. Therefore, with $1 million invested, your money isn't just supplementing your cost of living, it has the potential to finance your entire cost of living. Your investment portfolio becomes your most loyal employee, working around the clock, 24/7, generating income while you are asleep, while you are on vacation, while you are having dinner with your family, or while you are indulging in your hobbies. This is the first wealth milestone where capital begins to outperform labor for the average person. After you cross this line, your entire relationship with money undergoes a fundamental transformation. You stop functioning as a saver and start operating as a capital owner. These two roles might sound interchangeable, but they represent completely different psychological and practical realities. As a saver, your thinking remains fixed on accumulation. Every dollar matters because you are still constructing something. Your focus is on growth, on adding more to the pile, on hitting the next target. Your financial game plan is all about offense, constantly hunting for ways to earn extra income and save more. But once you step into the shoes of a capital owner with substantial invested assets, your whole mindset pivots toward preservation and fine-tuning. You are no longer trying to get rich. You are trying to stay rich, and that demands a completely fresh set of competencies, tactics, and mental frameworks. The mathematics alone is sufficient to revolutionize your perception of risk. When your portfolio sits at $20,000, a 10% market downturn wipes out $2,000. That hurts, but you can recover. When you have $1 million on the line, that identical 10% drop costs you $100,000. Suddenly, market swings are no longer just digits flickering on a screen. They become real money enough to cover multiple years of daily expenses. Yet here is the fascinating twist that most people fail to recognize until they live through it. Once you have substantial capital in the game, market crashes stop feeling like catastrophes and start feeling like golden opportunities. When your $1 million is churning out consistent income, you possess the financial padding to ride out short-term storms. More importantly, you hold the firepower to capitalize on situations that require upfront cash. This is exactly how the wealthy truly distance themselves from the pack. They deploy market panics to scoop up additional assets at bargained-in prices. They command the resources to jump into opportunities that demand serious money. They can afford to swing for the fences with calculated bets because their baseline lifestyle is already secured. Your connection to work undergoes a complete overhaul once you blow past the $1 million barrier. I'm not suggesting you immediately hand in your resignation. Although some people do go that route, I am talking about operating from a position of leverage, rather than one of desperation. When your investment returns could theoretically cover your essential living costs, every career move turns into a conscious choice rather than a forced necessity. You gain the freedom to walk away from soul-crushing workplaces. You can push harder during salary negotiations because you aren't panicked about the next paycheck. You can take smart gambles like launching a business or pivoting to a new industry because you have a financial safety net that won't vanish if things don't work out right away. This psychological shift seeps into every aspect of how you approach professional opportunities. Perhaps a job offers lower pay but superior growth potential or better alignment with your personal value. With a solid base of invested capital, you can afford to take that chance. Maybe you have always dreamed of starting a company but feared losing a steady income stream. A $1 million portfolio doesn't erase the risk, but it provides a buffer that makes bold moves far more feasible. The interesting side effect is that this newfound self-assurance frequently leads to even better financial results. People who aren't acting out of desperation tend to make superior decisions. They negotiate from a posture of strength. They select projects and roles that match their abilities and passions rather than simply taking whatever covers the bills. But perhaps the most profound change involves how you value time itself. During the grind toward your first million, any hour not spent earning or saving feels like a waste. You are perpetually calculating the opportunity cost of leisure. However, once your capital is pumping out substantial income, you wake up to the fact that your time has become more precious than your immediate earning power. This is the moment when people start making radically different choices about their daily lives. They might cut back their working hours or gravitate toward work that offers deeper personal satisfaction. And, even if the paycheck is smaller, they might take longer vacations without sweating the lost income. They might pour more hours into family or hobbies that generate zero revenue but provide genuine happiness. The $1 million mark also opens the door to entirely new categories of investment opportunities when you command substantial capital. Minimum investment requirements that once seemed impossible suddenly become attainable. Private equity funds, real estate syndications, business acquisition deals, and other high-barrier options land on your radar. These aren't just abstract strategies reserved for the ultra-wealthy. We are discussing real opportunities that become accessible once you have a $1 million foundation. And they can turbocharge your wealth building far beyond what most people imagine. For example, many real estate investment trusts and private funds set minimums of $50,000 to $100,000 per position, when your entire portfolio is only $20,000. Those minimums are completely out of reach. But when you are managing a $1 million portfolio, you can comfortably allocate 5% or 10% to these higher yield plays without putting all your eggs in one basket. Your access to leverage also changes dramatically. Banks and financial institutions treat you with a different level of respect when you have significant assets on your balance sheet. Getting approved for an investment property loan becomes far smoother when you can point to a mountain of liquid investments as collateral. Business acquisition loans, which often require hefty down payments and proven cash reserves, suddenly become realistic options. Now here is where the plot thickens, and it catches most new millionaires completely off guard. The psychological pressure actually increases in some unexpected ways. When you had $50,000 invested, a 5% loss in a market downturn cost you $2,500, painful, but not devastating. Well, when you have $1 million invested, that same 5% drop means losing $50,000. Pause and think about that for a second. You could lose more money in a single bad week than many people earn over an entire year. Your daily portfolio ups and downs start exceeding the monthly salaries of most of the population. This creates an entirely new breed of financial anxiety that you simply cannot grasp until you have lived through it. I have observed people hit their first million and then become obsessed with refreshing their brokerage apps 10 times a day. They compulsively check their balances, watching their net worth swing by tens of thousands of dollars based on market movements that are totally outside their control. It is like suddenly realizing your financial future is strapped to a roller coaster that never hits the brakes. This explains why so many individuals who cross the $1 million threshold start steering their investment strategies toward more cautious approaches. They begin prioritizing capital protection over aggressive expansion. The risk appetite that carried them to $1 million is often not the same risk appetite that will help them preserve and grow that $1 million. You start thinking about asset allocation through a different lens when the figures get large enough to matter. Maybe you felt perfectly comfortable holding 80% of your $50,000 portfolio in growth stocks. But having $800,000 parked in volatile assets might keep you staring at the ceiling at 3 a.m. even if the percentage allocation is exactly the same. This lean toward preservation isn't purely emotional, it is mathematically rational. When you have $1 million in the game, you are no longer hunting for a home run. You are trying to avoid striking out. A 20% loss when you have $50,000 invested sets you back $10,000. A 20% loss on a $1 million portfolio sets you back to $100,000 and potentially years of forward progress. But here is the fascinating quirk of human psychology and money. Despite all these fresh anxieties, most people who cross the $1 million line report feeling fundamentally more secure than they have ever felt before. It isn't because the money wipes out all uncertainty. It is because it provides a foundation that feels solid enough to weather the vast majority of storms. When you know your investments could theoretically fund your lifestyle forever, it changes how you think about every other risk in your existence. Job security becomes less critical when you have years of living expenses flowing in passively. Health insurance gaps become less terrifying when you have substantial assets to cover unexpected medical bills. Economic recessions become less personally threatening when you own assets that have historically bounced back and grown over time. This security gives birth to what I call the optionality mindset. Every major life decision transforms into a choice between multiple valid paths rather than a desperate scramble to avoid financial ruin. Do you want to live in an expensive city because you adore the culture? Or move somewhere cheaper to stretch your money further? Both become legitimate options when your baseline financial needs are already handled. Do you want to start a business that might fail, or take a steady job that might bore you to tears? When you have substantial invested capital, you can afford to place a bet on yourself in ways that would be reckless without that foundation. The worst-case scenario for most entrepreneurial adventures isn't poverty, it is simply returning to your previous lifestyle while your portfolio keeps churning out income. This optionality extends to family decisions as well. Having children becomes less financially stressful when you know your investments can help cover the added costs. Supporting aging parents becomes more feasible when you aren't living paycheck to paycheck. Taking time off for major life events no longer threatens your long-term financial security. The $1 million mark also unlocks what I call the compound acceleration effect. This is where the mathematical advantage of large capital amounts becomes almost ridiculous. If your $1 million grows by just 8% in a single year, you have pocketed $80,000 without lifting a finger. That is more than many people contribute to their retirement accounts over several years of aggressive scrimping. This acceleration means your second million often arrives much faster than your first. The initial million might take 15 to 20 years of disciplined saving and investing, but once you have that base, the combination of continued contributions and compound growth on a much larger foundation can slash that timeline dramatically. Here is the part that truly separates millionaire investors from the rest of the pack. They start treating tax optimization as a core pillar of their strategy rather than an afterthought. When your investment gains are generating serious income, the gap between paying 15% versus 25% in taxes becomes enormous. Tax loss harvesting, asset location strategies, and retirement account fine-tuning become well worth the complexity, because the dollar amounts involved make the effort pay off. The wealthy don't just have deeper pockets, they have access to better financial infrastructure, private banking relationships, dedicated financial advisors, and sophisticated tax planning services. All become economically justifiable when you have substantial assets to manage. These services aren't necessarily superior because they are expensive. They are superior because they are built for people whose financial situations are complex enough to benefit from specialized expertise. But perhaps the most profound change that occurs after crossing the $1 million threshold is how you think about legacy. When you are grinding toward your first $100,000, your focus is locked on your own financial security. When you have $1 million invested and it is growing faster than you can spend it, you start contemplating what happens to this wealth after you are gone. This isn't just about passing money to children or charities. It is about recognizing that you have built something that can outlive you and continue generating value for decades or even generations. Why? Our investments become less about funding your own lifestyle and more about stewarding capital that could impact multiple lives over long stretches of time. This shift in thinking affects everything from your daily habits to your long-range planning. When you are accumulating your first $100,000, every dollar feels precious because progress is slow and visible. You celebrate each new milestone because they represent months or years of disciplined behavior. But when you have $1 million generating $70,000 annually, you start thinking about money in completely different units. Instead of counting individual dollars, you start thinking in terms of months or years of financial independence. A $10,000 expense is no longer devastating because you know your investments will replace that money in less than 2 months. This creates what I call financial breathing room, where short-term setbacks no longer trigger the same panic they used to. Now here is where things get counterintuitive and, honestly, a little bit absurd. The more money you have invested, the more pathways you unlock to make even more money with less effort. It is as if the financial system has secret levels that only become accessible when you hit certain thresholds, and the vast majority of people have no clue these levels even exist. Take leverage as an example. When you have $20,000, banks view you as a potential liability. When you have $1 million in liquid investments, banks start treating you like a preferred VIP. Suddenly, you qualify for investment property loans with far better terms. You can secure business lines of credit based on your asset base. You gain access to margin lending that allows you to borrow against your portfolio for new opportunities without selling your holdings. This access to cheap capital is exactly how the wealthy truly separate themselves from the crowd. They don't just save their way to riches. They use their existing capital to acquire even more capital-producing assets. It is like holding a key that unlocks doors most people don't even know are there. Real estate becomes a completely different ballgame when you have substantial liquid investments. Instead of scraping together a down payment and crossing your fingers for mortgage approval, you can move swiftly on opportunities, cash offers, bridge financing, and investment property acquisitions all become viable strategies when you have a $1 million foundation. But perhaps the most significant shift is how you perceive time and opportunity cost. While you are climbing toward your first million, any hour not spent earning feels wasteful. You are constantly running the numbers on whether that vacation or hobby is worth the lost income. Potential. Once your capital is delivering substantial returns, you realize that your time might actually be more valuable than your immediate earning capacity. This is when people start making choices that look financially irrational to outside observers. They might turn down higher-paying jobs because the work culture is poisonous. They might take extended breaks to travel or be with family. They might chase passion projects that don't produce immediate income but feed their soul. From the outside, these decisions appear financially irresponsible. Why would someone with $1 million walk away from more money? But that is precisely the point. When your basic financial needs are covered by passive income, your optimization goal shifts from maximizing earnings to maximizing life satisfaction. Your relationship with risk becomes completely inverted once you cross this line. When your capital is limited, every investment decision feels critical because there is no safety net. One bad move could erase years of progress, but when you have substantial invested assets, you can afford to take calculated risks because the downside is manageable. This risk tolerance paradox is fascinating to witness. The people who can most afford to lose money are often the most conservative with their core holdings while simultaneously being more aggressive. It's smaller slices of their portfolio. They will keep 80% in stable, diversified investments while using the remaining 20% for higher risk, higher reward opportunities. What is really interesting is how this affects your relationships with other people, particularly around money conversations. While you are building wealth, you are eager to discuss strategies, trade tips, and learn from others in similar situations. But once you have substantial assets, money talks become more complicated. You can't really vent about investment volatility when your daily portfolio swings exceed most people's monthly salaries. You can't discuss the stress of market downturns when you know your lifestyle isn't actually under threat. You certainly can't bring up the burden of managing wealth when most people are fighting just to save anything at all. This creates a strange form of social isolation that many new millionaires never see coming. The financial worries that dominate most conversations become irrelevant to your situation, while your actual concerns sound like luxury problems to people still grinding toward their first $100,000. So, there you have it. The $1 million rule is not merely about hitting a specific number. It is about crossing into an entirely different financial dimension where the fundamental rules of money change forever. You evolve from a person who barters time for cash into a person whose money works harder than most people do at their full-time jobs. The leap from accumulator to capital owner reshapes everything about how you think, how you work, and how you live. If you are serious about building wealth, understanding this milestone hands you a roadmap for what becomes genuinely possible once you arrive.